Mark and Linda spent 35 years doing everything right. They maxed out their 401ks. They let the money grow, untouched, for decades. And when Mark retired at 65, their financial advisor told them the same thing most advisors say: "You're in great shape. Just let it keep compounding." So they did. They delayed Social Security. They lived on savings and Linda's pension. And every year, the balance in Mark's retirement account got a little bigger. What nobody told them, what almost no one tells you, is that at age 73, the IRS sends you a bill. Not for what you spent, for what you saved. It's called a required minimum distribution, an RMD, and here's how it works. The government gave you a tax break when you put money into your 401k or traditional IRA. Taxes were deferred, not erased. Every dollar that went in and every dollar it earned has never been taxed. The IRS was always planning to collect. Starting at age 73 for Mark's generation, the law requires you to withdraw a minimum amount from your tax-deferred accounts every single year. For people born in 1960 or later, that clock starts at 75. Either way, you don't get to choose whether to take it. You don't get to skip it because you don't need the income. If you miss it, the penalty can be as high as 25% of the amount you failed to withdraw, although it may be reduced if the mistake is corrected promptly. The formula is simple. Take your account balance on December 31st of the previous year, divide it by a life expectancy factor from the IRS table, and that's your minimum for the year. At age 73, that factor is 26.5. So if you have $1 million in your IRA, the IRS requires you to withdraw at least $37,700. But here's where it gets interesting and expensive. The number 26.5 sounds manageable, roughly 3.8% of your balance. But that factor shrinks every year. At 75, it's 24.6. At 78, it's 22. By 80, it falls to around 20, which means every year you're required to pull out a larger percentage of your remaining balance. And here's what makes this a slow-motion problem. The longer you leave a traditional retirement account alone, the more it grows. The more it grows, the larger your required withdrawal becomes, not just in percentage, but in raw dollars. Mark had $850,000 in his 401k when he retired at 65. 8 years of compound growth, untouched, could put that number closer to $1.3 million by the time he turns 73. His first-year RMD, nearly $49,000. The required percentage keeps rising after that. In years when the portfolio grows, the dollar amount climbs with it. He never asked for this income. He doesn't need it to cover expenses. But it's coming, and it's going straight onto his tax return. By itself, $49,000 is manageable. The problem isn't the RMD alone. The problem is what it runs into. By the time Mark and Linda turn 73, their retirement income looks like this. Linda's teacher pension brings in $1,800 a month, $21,600 a year. Mark maximized Social Security and waited until 70. Linda waited too. Together, they collect about $62,000 a year. Add Mark's first RMD, $49,000. Now watch what happens. First, federal income tax. The RMD is added on top of their pension and the taxable portion of their Social Security. After standard deductions, Mark and Linda are not in a punishing bracket today. But the RMD keeps growing, and every additional dollar it climbs can push more income toward higher marginal tax rates. The kind of drift that is nearly impossible to stop once required withdrawals have begun. Second, Medicare. The government uses your income from 2 years prior to set your Medicare Part B and Part D premiums. A program called IRMAA, the Income-Related Monthly Adjustment Amount, kicks in when income crosses a threshold. As a married couple, Mark and Linda are not over that line today. But a growing RMD, a Roth conversion that goes too far, or a large capital gain in any given year could push them across it. And because Medicare looks back 2 years, the surcharge may arrive long after the income event that caused it. Third, Social Security. There's a calculation most people have never heard of, called combined income. It's your adjusted gross income plus half your Social Security benefits. For married couples filing jointly, Once that number exceeds $44,000, a threshold set in 1993 and never adjusted for inflation, up to 85% of your Social Security benefits become taxable. With Linda's pension and their other income, Mark and Linda likely crossed that threshold as soon as Social Security began. Up to about $52,700 of their Social Security benefits may be included in their taxable income. And there is one more risk almost no one plans for. If one spouse dies, the survivor may still have most of the same retirement income, but now files as a single taxpayer. Linda's pension doesn't disappear. She keeps the larger of the two Social Security benefits, and if Mark's IRA passes to her, she'll eventually have her own RMD from that account. But filing as a single taxpayer means narrower tax brackets and lower Medicare income thresholds. What was safely below the IRMAA line for two people can cross it for one, almost automatically in the first year alone. The bomb that was quiet for a couple can become very loud for a widow. Here is what keeps retirement planners up at night. Every year that Mark's account grew in his 60s, he was building a larger future RMD. The compounding that felt like a gift was quietly making his future tax problem bigger. And the window to do something about it, to convert some of those dollars to a Roth, to reshape the income stack before the mandatory withdrawals begin, that window exists between retirement and age 73. For most people, that's somewhere between age 60 and 72, a period when taxable income is temporarily lower before RMDs begin and while Medicare premiums can still be managed deliberately. For many retirees, it may be the most valuable tax planning window of their lives. Most people let it pass, not because they're careless, but because no one told them the clock was running. So what can you do? 3 strategies are worth knowing. Each works best when started before age 73. The first is Roth conversion. Each year during the window, you move a portion of your traditional IRA into a Roth IRA. You pay income tax on it now, at today's rate in a year when your income is lower, and that money grows tax-free. Roth IRAs have no required minimum distributions during your lifetime. You shrink the future RMD base before it becomes a problem. The second is a qualified charitable distribution. Once you reach age 70 and a half, you can direct money from an eligible IRA straight to a qualifying charity, up to the annual federal limit. That withdrawal counts toward your RMD, but it never touches your taxable income. If you're already charitably inclined, it's the most efficient dollar in retirement giving. The third is coordinated withdrawal planning. Roth conversions, Social Security, and Medicare premiums should not be planned in isolation. A conversion that looks efficient from a tax bracket perspective may become more expensive if it triggers higher Medicare premiums 2 years later. The goal is not to convert as much as possible, it's to convert the right amount each year. Mark and Linda's story doesn't have to end with a surprise tax bill. If they had started Roth conversions at 65, even modest ones, $30,000 to $40,000 a year, they could have moved a significant portion of Mark's account to tax-free status before the mandatory clock started. Their RMDs would be smaller. The income stack would be lower. The Medicare premium surcharge might never apply, not just for the couple, but for the survivor too. That doesn't mean converting everything or converting at any cost. It means modeling the trade-off before the decision becomes mandatory. The RMD time bomb wasn't set at age 73. It was set the day you opened a traditional 401k. And the only way to defuse it is to start before the timer runs out. If you're between 60 and 72 right now, that window is open.